Hey, welcome back to the Clear Close podcast. Today we got a great episode. Potential changes to your credit score might be coming soon, and short-term rental markets may collapse. Jason, how's it going?
Pretty good, Peter. Hope you can hear me loud and clear, unlike last week, right?
Yeah, we had a little bit of technical difficulty with your audio, but looks like you got a new setup.
I do. So, trying out a different mic last week was really painful for me to listen to, even because I just kept hearing the static and the popping. It was just not cutting it for what we're trying to do.
Yeah,
Get better.
slowly upgrading the studio. My background has changed.
Mhm. I'm moving mine around every day or every week, so
Yeah,
we're trying to be comfortable, right? We want to be real with it.
for sure. So let's move on to the first topic. We have some interesting news. It's not breaking news, but it does matter to the industry that we're working in, which is mortgage and real estate. Potential changes to how your credit score or how people's credit score may be evaluated, I guess. Let me go ahead and share my screen. I found this article in the Commonwealth Fund, and if we scroll down, um, in early January, the outgoing Biden administration finalized a new national standard that bans credit rating agencies from including medical debt on most consumer credit reports. Good for consumers. The new rule, which was slated to go into effect in March, prohibits lenders from considering medical debt when assessing the creditworthiness of borrowers. However, the Trump administration has placed it on hold. Okay, so
Hmm.
the impact could be significant. Unpaid medical bills are the largest source of debt reported to collection agencies. About 15 million people have medical bills on their credit report, and that, wow, almost $50 billion worth of debt for medical expenses. Um, so if Biden's plan was to roll out, then all these debts, it would affect the DTI ratio of borrowers, correct?
Yeah. So medical collections always showed up in credit reports. So it's not always a DTI thing because there's no schedule for payment in most of the collections. It's it's a dollar amount. And then net effect of that is it holds down or suppresses credit scores in a lot of cases because the way the agencies calculate that debt or risk affects the actual qualifying credit score. So I've seen cases where like a family was trying to acquire a new home and they weren't aware, right, of the medical debt, and it
Mm,
ended up like a silent killer in the actual credit score because everything else was great, and then once we pulled the credit report, we saw that there was like an $800 medical bill, right, and that was in collections recently. So that credit score went from probably being somewhere in the 700s to down in like the low 600s. And when you have a big variance in credit score like that, it affects how you could qualify for a home loan. And especially if you have a lower down payment, tighter debt to income ratio, then there's a lot less there's more required compensating factors needed to get that loan to pass, like an FHA loan or a VA loan or conventional loan.
so if a person has recently gone to the hospital, shouldn't they know they have a pending medical bill on the record?
That's a tricky part because it's actually happened to me too. Funny thing, I have insurance. I think I have pretty good insurance. But when we went to our providers, right, our primary care physicians for our kids, they were in network when we searched them online. But when we actually got all the medical care provided, completed, we find out like 6 months later that they weren't an approved physician, right? So if it wasn't for us just constantly looking at every single medical bill that comes in, we wouldn't have even known that we owed that physician multiple visits worth of bills, which weren't even covered, where we
Oh,
initially thought they were covered. So I can only imagine if you're in an emergency situation and you went to the ER and your kid broke an arm, right? I don't think the first thing that comes to mind is my insurance going to cover it or not? Or you might have insurance and you think it's covered because you provided all of that, and then you don't get a notice in the mail, or it just slips by, and you don't, and all of a sudden, lo and behold, the emergency last year wasn't covered, right? So you just never know. It's lack of transparency, really, on the medical billing side, in my opinion.
Wow. Yeah, so there could be a multitude of issues why someone has a medical debt on their file.
Yeah, it's not just about headlines like Biden or Trump. It's literally taking someone that could have qualified for a home, and then now they're not qualified anymore. So, like, in my opinion, take the presidents out of it or the administrations out of it, Biden or Trump. The benefit of having this rule in place was to
Hmm.
help people get into homes, and to have that put on pause due to
Hmm.
politics. It really sucks, frankly speaking, because this was to help homeowners afford and get into homes. So
Yeah, the
it's
average
like
American, right?
the average American all across the country that has families, right? You and I,
Hmm.
Peter. Like,
Hmm.
imagine if something happened and you were trying to buy a home yourself, or even refinance a home, right? And then you didn't know there was a medical bill for a visit like a year or two ago that you never got notice of.
Do you think the lenders would readjust their risk tolerance and maybe charge higher percentages, like overall to all Americans? Because like what insurance companies are doing in California, we're having to pay like 20% more insurance premium because of the risk of wildfires is still too big in California.
I mean, it's ultimately going to come down to how accurate that information from the credit report is, right? So if we start seeing higher credit scores, then that risk, especially if 30% of the population is carrying medical debt of some sort, it'll and it's now no longer reported on the credit reports, then I would imagine Fannie and Freddie would adjust their loan level pricing of the LLPAs to account for that, right? Because that risk based pricing is based on the likelihood of default, right?
Right. Because I remember the big thing about Obamacare, people received it very well and people really benefited from it, like individually, but
Mm-hmm.
broad sense, you know, everyone had to pay more for medical insurance.
Mm-hmm.
Just came out of everyone else's pocket.
Yeah.
So yeah, we'll see. Might be good to get more people in homes, and that might have a positive effect on our economy. So who's to say? Like we never really know how things shake out. Um, but definitely having more Americans in homes, that can't be a bad thing, right?
Mm-hmm. So yeah, it's going to affect you. It's going to change whether you're approved for that $400,000 loan or not, and it's going to affect if your rate's 6.5% or 7.5%, right? Because you went from 700 to 600. That makes a huge difference.
Yeah. It's
We all want a system that rewards good behavior, right? So if the real question is, should people be penalized for getting sick? If not, what's the right way to handle it?
Yeah, I definitely penalize my kids for getting sick. I'm like, it's your fault. Why'd you
It's
put your
not.
finger in your mouth?
I know, right? And then it's like, and then even, and they did it, and now you're up at like 4 a.m. taking care of them for whatever reason.
Yeah, we're the ones getting penalized for our kids getting sick. That's right.
But at the end of the
Oh
day,
man.
it's not just about a credit score. It's access to the opportunity of owning a home or refinancing, right? And at the end of the day, it just affects all of us.
Um, but you know what's another crazy thing that could potentially play into all of this credit scoring is, did you hear about the 23andMe bankruptcy?
Yeah,
You know where I'm going with this, right?
I know. I can kind of guess where you're going with it, but yeah, go
Uh-huh.
ahead.
Yeah, so they're going bankrupt. So in their court filings, all of their assets are up for sale, and one of their largest, like the most important asset that they have is the information, the DNA information from all the clients, right? So potentially insurance companies, lenders can all grab that DNA data, and as long as they have this set of your genetic data, they will know what certain types of people, what certain lifestyles, geography, heritage, whatever. Like even if your if you've ever given your DNA to 23andMe and now your lender has your DNA and they know like, oh, you have a medical history, then man, like I don't know if they'll ever admit it, but they could potentially deny you coverage in the insurance side, or they could deny you a loan because they know you already have medical history, or you will have medical history down the line, and you're more of a risky customer.
I don't think they can approve or deny you for those types of characteristics or DNA traits because our lending side is very protected, right? There's protected traits like sex, marital status, etc. You can't make a lending decision based on that. But
Yeah, but I don't think health is a protected status.
it could be a loosely interpreted one, but I would imagine if it was excluded, it probably eventually will get amended to be included. But I can see where you're going. It's like it's a similar thing. If you saw the news with Rocket Mortgage buying Redfin for, I believe, $1.4 billion. So just like 23andMe has important DNA data up for sale, potentially through that bankruptcy, it's a lot of private information, your genetic code that any company could acquire now for pennies on the dollar. And with Redfin and Rocket Mortgage, for example, like that one to me is a lot bigger news than 23andMe because now it's like they have your shopping behavior, they have your search history. Rocket will have it's more of a data acquisition company at this point because I know they they are very interested in servicing customers, capturing audience attention at a specific time, and now you have a real estate front side where you have millions of users actively searching listings online and seeing buying behavior and patterns that you could then now present as the sole lender for a solution to buy your home or sell your home. So it's pretty amazing to see it.
You know, this whole conversation kind of reminds me of a situation. Um, I haven't told you the story yet, but I had a friend who got into a car accident some years ago, and he lost his job, and he didn't take care of the medical insurance after the fact. So when he got
Mm.
into the car accident, he didn't have um, coverage, and so it was, very expensive. He had some broken bones and whatnot, and his parents, um, you know, I told them about using a HELOC, and I think they were able to cover all the medical bills using the equity in their home, which was a pretty interesting use of it, I thought.
Yeah. When it's an emergency, it's good to know you have that peace of mind too and access. And imagine if the worst case scenario, I'm just saying like that's I'm hoping your friend is okay now, but imagine if the parents had medical bills or collections, right? Would they have had access to that equity without a loan, or would they have been able to get a loan, or would they have had to think the unthinkable, sell their home so they could help their son recover? So
Hold on, I'm a little bit confused. Are you saying that if the parents got into an accident, they wouldn't be able to
no,
qualify for the HELOC?
no, I'm saying he's your friend's lucky the parents had access to equity and the parents
Oh,
probably had good
oh,
income. Because imagine if the parents had that invisible anchor and they had medical bills and collections and their score wasn't
yeah,
cash out. Like,
right,
what would
right.
you have done?
Yeah,
You would have been in like it's like it snowballed into an even worse situation.
yeah, he got
And then,
lucky, yeah, for sure. Because he
but
was kind of, like I got mad at him because like why didn't you take care of your medical insurance? Like you
mhm.
should have taken care of that, but you know, lazy, I
I,
guess.
that's a different topic, but just like thinking about it with what we're talking about with like the medical and collection, that medical debt and stuff like that, because it's more. I've seen situations where parents had to do what you're talking about for their parents, like the grandparents, right? Not the kid.
Mm-hmm.
And they weren't able to access the equity to get that medical care for them.
Oh man,
And
that's horrible.
it's because they had medical collections themselves. So it's sad. Like
Mm-hmm.
it's because it really affects us at the end of the day. It affects people that really need the help at the end of the day.
Yeah, and that's a horrible feeling too because when you want to like you live in your home, you pay your mortgage and you know these products exist and you're like, "Oh, I can, I have the safety net of my home equity, right? I can pull it out and then something happens and like, okay, cool, I have the safety net. I'm gonna go reach into this, um, I'm gonna go reach into it, and then you can't because
Hmm.
something you didn't know about. And yeah, that's a really
Yeah.
bad situation.
Or another client of mine out in Malibu right now. They had a home, the home that was affected by the wildfire. So it's
Hmm.
like he has insurance, he wants to rebuild, but he wants to have more money to rebuild, right? Or have access to it just in case. We can't even get him a HELOC because there's no home anymore. It's like it's crazy.
Oh man, we should have an episode where we do talk about what happened in California because someone watches this video 10 years from now, they'll be like, what happened? Um, so for context, I guess for the future of whoever watches this, um, was it this year, Jason?
It was this year.
It was this year, 2025. Yeah. Massive fires in Southern California. The Pacific Palisades, which was a very high income neighborhood. Beautiful houses. Some houses were owned by celebrities up to like 10, $15 million. Some and a lot of normal houses, right? And then even all the way through to like Malibu, all gone. Just an entire city wiped out by wildfires. And
Hmm.
has ripple effects to all the residents living out in California. Um, and we'll see how that plays out. But yeah, if you don't have a house, you don't have equity to pull out from, which is I don't know how people are gonna handle that situation.
Yeah, it's I can't even imagine what the insurance situation is like. I know that a couple of those homes that were devastated have already transacted selling just the bare land, and a lot of the
Hmm.
sellers are saying they don't have it in them to rebuild. So
Yeah,
it's a sad situation, and it's definitely a topic we should talk about because from what I'm seeing, I think you shared the article the other day. It was State Farm's looking to raise rates by 20% for the whole state.
I mean, we can cover this in detail in a different episode after we've done, the right amount of research. But there's a lot to say about the housing market, specifically in Southern California.
Absolutely.
But what do you think about buy now, pay later, and that potentially being considered into the FICO score? Do you think big deal, little deal, nothing burger? What do you think?
That's going to be a major change to lending guidelines, Peter, if they do the buy now, pay later and
Hmm.
add it into your FICO score. Because anything that's like 11 payments or less than 1 year remaining, like installment loans, we never factor it in as a lender for most loans as a debt to qualify today, right?
Hmm.
So if they did add that in, that would hurt a lot more people than I think these medical collections because most people don't have the money to pay those short-term debts down, let alone put a hefty down payment. So it could affect multiple layers really because it's now you're paying off those short-term debts potentially, taking away from your down payment, and your offers get weaker and your loan qualifications get tighter just so that you can throttle back on the debt to income, but now you have less reserves that were a qualifying factor potentially, or you have other area like or a smaller down payment. So now your offer looks weaker because you might have had 5% down, but now you have to do the first time home buyer 3% down with conventional loans because you're paying off all those short term debts, just so your debt to income is right within reason to pass. And then rates are high today. So
Hmm.
it's like so many levers that you're pushing and pulling. And that just definitely adds to another layer to the mix. But again, I think it would be more hurtful than helpful if that was added.
It'll be an issue, definitely. And we're seeing a lot more buy now, pay later. I think the latest statistics shows that it continues to rise, people's usage of buy now, pay later programs. I think people's credit cards are maxing out, so they're taking advantage of the Klarnas and, you know, whatever they're buying on their credit card these days. You can do buy now, pay later stuff, like put
Mm-hmm.
those into installment period. So you're like credit card on credit card base essentially.
But it's those are typically lower rates, no? They're considered installment loans. So it's like
It
I've
is, it
seen
is.
them before, like the PayPal like 6 month or 4 month payment option. Is that what you're talking about?
Uh, there's, I have Chase. Chase offers that too. So if I buy anything over $200, there's like a little notification. Do you want to put this into installment periods? And I get options of like 3 to 6 or even up to like 9 payments. But then there's fees, that
Right.
get added to
It's
that.
also reported on your credit card too, no? Like if you used your credit card pay later feature, it would just add that debt to your credit card balance, no?
Yes, it does. Yeah, that the balance stays
So that
high.
already comes
Yeah,
against you.
right. But the Klarnas, those programs don't. The Affirms and
The
all those guys.
standalone ones, like the PayPals, the
Uh,
Klarnas. And then there's like what was that other company? I think there was another competitor to that, right? Where
Klarna,
there's a
Affirm,
lot of friction.
and I
I was
forget.
reading it the other day. I
There's
forgot the name.
there's
Yeah.
a lot of them now.
Hmm.
There's a lot of interesting things going on in the credit world. Even a potential for buy merge credit reports instead of try merge credit reports. Have you heard about this as well?
I've heard about it, but how does a buy merge work? I just pick the two best credit scores I have and use that lower score. But isn't that the same thing as a tri merge anyway? Because you're using the middle score out of
Hmm.
the three. So wouldn't you just pick the
Um,
two highest scores and then you end up with the same lower score?
right, but like there's customers who say, this company is showing me this number, another company showing me another number, and like they could be wildly different, like up to 50 points, even like 80 points different. And that's
Hmm.
just from what the customer sees on their end. Who knows what the other buckets are showing, right, to lenders?
I think we also need to have another episode on credit too, because what consumers see are typically not mortgage scores. I've never worked with auto or any other industry for finance, but I can tell you the mortgage scores that we access, it's definitely different from consumer scores. So a lot of times people think FICO score and it ends up being like a Vantage FACO score, which has nothing to do with mortgage rating. It's like a thermometer for seeing if you're lukewarm or hot, right? On credit,
Right,
it's
but
like an
mhm.
indicator if you're going the right direction. But I just don't understand how a bi-merge would be better than a tri-merge, because if you had a middle score that if your scores were 700, 650, and 600, if you had two scores 650 and 600, now you don't qualify at all. Or if you pick the two highest, you end up with 700 and 650, and you're still at the middle score that you were at, or it goes 700 and 600, and you're definitely not qualified.
Yeah, well, maybe it's like a play for competition, like increased competition between the three credit reporting agencies. So, um, you know,
Maybe.
get
I
get
don't
them
know.
to be,
It's
a little bit more lenient on the customers to see which one gets used more. Don't they get paid based off of usage?
yes, credit reporting agencies make money off the credit reports that are sold. So for lenders, it's a very big expense, especially over the last 5 years, where credit reports were $21 for all three. Back in like 2019 to 2022, and then like 22 to 23 and up, all of a sudden it ended up being a very high cost. And in some cases now, some credit agent reporting agencies cost almost $100 to get one credit report to help one customer. So buy merge is probably cheaper for us as a originator because we're only using two credit reports.
So yeah, that might be a little bit too much getting into the weeds for average consumers. Maybe it will mean nothing to an average consumer, right? Whether it's a buy merge or a try merge, like who cares? I think it might be more impactful for lenders and people like us that are actually utilizing these functions and these products on a regular
It
basis for our
Got to
business.
remember too, though, we can't ignore it because if it costs us more money to do, who's paying for it at the end of the day?
That's true. That is very true.
It comes down to consumers. So if we can efficiently help customers better, that allows us to pass those savings down on to the customers because ultimately we want to help you. So if things cost more for us to do and inflation hits us through increased operational activity, it bottom line will affect the consumer as well.
Yeah, maybe that's why they're moving to a bi-merge instead of a tri-merge to help reduce the overall cost of everyone uses loans, anything with the finance program, right? So like
Yeah,
they're
100%.
yeah,
All
cars,
business activities is some
appliances,
form
yeah.
of, there's like auto loans, home loans. Just I'm assuming student loans don't look at FICO score, but
Yeah, probably not.
medical loans, dental financing, that could affect you for qualifying or not. Financing your kid's ortho treatment because your dental plan doesn't cover it.
Yeah, we yeah, we're gonna have to do that with one of our kids too. All right, let's move on to the next topic.